So welcome, Shashank.
Thank you, Prince, for inviting for today's session.
Yeah. So, guys,
Looking forward
today's
to.
session would be more around micro and small cap investing. So, any questions around that topic are welcome. So, feel free to send in your speaker request or type in the comments. So, Shashank, we know when it comes to micro or small cap, these are basically under-owned and under-researched companies. So, what exactly to look for in such companies? How we should initiate I mean, when it comes to researching those companies.
Right. So, see, the research of these companies is completely different compared to the well-discovered companies, which are Nifty 50 and Nifty 100 or top blue chip companies, because lot of information is already available, lot of history is available, probably 15, 20 years or more than 20 years history is available. So research becomes easy. But the problem is that as they are like widely discovered, the margin of safety sometimes gets very limited because of the discovery. And that's what is interesting about the small and micro cap stocks, that the horizon, I mean the number of uh, opportunities are quite huge compared to top 50, top 100 nifty stocks or well discovered stocks. And the research is also very less, because of the disclosures are not proper, or the analysts are not interesting, or mutual funds cannot buy these stocks because they are very small. But we as a retail investors don't have that issue on a capital. Mutual funds have generally a very large capital, so investing in micro and small caps hardly makes any difference. They have their market cap mandates and all. So I don't think very high number of mutual funds say invest into 5 6 crores market cap company. So it doesn't mean that the company is bad. The question is how we can research and how we can differentiate between the good business and bad business. So as you asked me, how to start the research. So there can be various parameters, various methods. I think firstly one should understand what is his circle of competence, which means the micro cap and small cap is the ocean. There are n number of sectors, there are multiple stocks, so definitely one cannot understand everything. So firstly, I think first filter would be the sector filter. You go with the sectors which you understand, um, and then slowly keep building your competence and circle. So that would be the first filter. So suppose there are say 2 3 thousand of these smaller or micro cap companies. Just look for your sectors, probably 2 3 sectors, 4 sectors, and then shortlist those stocks. Once that is done, then you can apply certain screening criterias. So it again, it depends on what kind of investor you have and what kind of expectations you have. You can screen the stocks accordingly. I will share some of my parameters which I generally screen with. So so I generally don't look for a business, say, which is at very high profitability or extremely high ROC, because generally sometimes it is priced in. So if the things are already priced in, then it becomes sometimes very difficult to get some extra alpha out of it. So generally you can look for a business which is say generating a ROC more than 15%, have decent margins, not very high, probably like in that range, and then look for the triggers. So triggers can come from the various categories. Like trigger can be the capex trigger. So companies already has completed the capex, but the revenues has not yet come into the PNL. So so that can be one trigger. That for that you can do the screening. Another trigger could be if there is any change in the management, if the family owned business is shifting more towards professionally owned business. So you cannot directly screen it, but you have to go to the company level And then you can have your debt to equity criteria as one of the very important criteria for the small or micro cap stocks can be how much EBITDA or profits they are able to convert into cash, because uh, uh, as I said, like there are huge opportunities in this space, but there can be a huge amount of landmines also, because um, a lot of data manipulation also happens in this case. uh, if you know what has happened between 2018 to 2020 in small mid micro space, then it was a very good learning that we have to be very careful while assessing these kind of companies. So look for the what kind of cash they are actually generating, what kind of the receivables they have, because showing a profit is very easy while collecting a cash is quite difficult. So one should also have the focus on cash, and cash flow should not be checked on a year to year basis, but we can like club last 3 last 5 years cash flow. And again it again depends on what is the story. So in small micro caps, what generally happens is, if there is a story, initially the numbers may not be there, and as soon as the number starts coming, the market also gives the full re-rating. So you have to look for your sweet spot, that like which kind of a numbers are you comfortable with. So these are the certain screening criterias. Along with that, I also go with the I also check in my circle if anyone has any good idea. They generally tell me like this looks good to them. So sometimes it starts with the story also. So the person tells me the full history about the company, and then I start with my understanding and my analysis. And one of the very key criteria in micro cap investing is scuttlebutt. You cannot directly rely on the numbers which are thrown at you on screener or from a balance sheet and various documents. So because that can be misleading, and it has happened multiple times in history. Like uh, like you just go through the history of 2018 to 2020, how many number of auditors have resigned, like even like Deloitte and all. uh, I don't want to name specific companies, but there are like many examples during that period. So so that's why on ground research is also important, and which is quite difficult also. But if you have that edge, it is all about the information edge. So if you have that information edge, then probably you can get those companies at much better valuations compared to what is known to market. So that's why you can go and talk to the industry people, the employees, check their products on ground. So micro cap investing, I feel it is not the investing which you can just do by reading the annual report and reading the conference call. That is definitely a very good start, because if you directly start doing the scuttlebutt, it can be challenging. But I also read a lot of con calls every day just to understand what other competitors or what is happening on a broader level. But these companies, as I said, the disclosures are very poor, but we can have a very good learning what is happening into a sector, what their bigger peers are doing, and then we can apply those understanding to the smaller companies. And then your question here will also get bit fine tuned when you will go and probably meet the management, or any employee, or anyone from the company. So that is in shortly what I generally look for. We can discuss this further as and when there will be more questions.
Yeah, right, Shashank. So, Shashank, in the triggers, just you discuss, you mentioned about capex, right? So we have growth capex and maintenance capex. So how one can identify, like, because do the companies mention it separately, or how one should be able to, see whether it's a maintenance capex or some new new capacity is coming in.
So if you check, generally maintenance capex is amount which doesn't increase heavily every year. Growth capex is the only amount which will be much higher compared to the maintenance capex. Plus, we need to understand the industry, which industry we are looking for. So there are certain industry in which the maintenance capex generally is a higher number, while certain industry are there like where they don't need a very high amount of maintenance capex, and then like according to the size of opportunity and like tailwinds, they generally keep doing the capex. So like it's I think like on a screener at least you can start tracking the gross block numbers and like change in gross block, and then you can dig deeper always on a balance sheet, and then check what is the change into ppe side, and then minor details and notes to accounts for that particular thing. But I mean, definitely one should look for the growth capex only. Maintenance capex not going to generate anything because that is just to sustain their plants and their assets.
Right. And when we talk about change in management, so how one should evaluate the new change would be in favor of the investors or not? Because at times it happens when a new uh, top position executive joins, so he has two choices. Like he take long term view in his mind and act accordingly, and on the other hand, it would be he will be more on cost cutting and those things so as to show increased earnings or so. So how one should go about checking the change in management?
Right, right. Yeah, it's a good question. So I don't think like there are any very strict parameters on how to judge the management, because it's not like we cannot compare that in any numbers. It is more of a art, and I think more and more number of case studies which you have, if you have historically, and if you track the better and better, your collective understanding becomes. So you see what has happened to say DFM food, or like say Sequent, or say wherever there is a private players are coming, like even in SCG case. So you should have, you can keep on building your case studies, and then I think it will be easier for you to understand that what new management can offer. Definitely, you have to look for like what are their intentions. Generally, I look for the managements plus the business. It's not only about the management. If the business is into difficult phase, then again, like the no management can immediately change the fortunes of the company. They will take their own time. So for example, there is a company which I'm tracking, say Leica Labs. So there also has been a change into a management. I think IPCA has taken some stake, like the majority stake. But I personally think it will take some time for till the company turns around. It's not going to happen from the next quarter or so, because the nature of industry is like that. So, so it's more about the business and the management, and at what cycle the management is coming, what is the intention of the management, what is the history of the management, and then you will get certain a vague understanding about how much time it will take for the turnaround and all. It depends, I think, on a industry to industry plus the cycle in which we are.
Right, Shashank. So, Karthik, I'll come to you after this question. So, Shashank, you talked about EBITDA to cash conversion. So, what is the healthy conversion rate which we should assume that it should be minimum this much and maximum तो कितना भी हो चलेगा, right?
I think it should be at least more than 70%, I feel. 70, 75%, 65 to 75% should be the benchmark. It should not be very, very less. And again, as I said, like we should not check it for a particular year, because in that particular year that may be certain like it might be misleading. So you can check it on a 3, 5, or like more than 5 year block, so that you'll get a understanding of the company, like how they able to collect the cash, and then combine it with the cash conversion cycle also, what are their receivables, how they able to collect, what are the historical bad debts which they have written off. So that also gives a good understanding of the like how much power the company have to collect the cash.
All right. So Karthik, you can unmute and ask your question.
Thank you, Prince, for the opportunity. I would like to know, like in that con call of HIL Limited, it was told that because of the headwinds in energy crisis in the Western, their outside acquisition have caused a lots of loss for the company this time. So I would like to know, like being a micro cap, how they can come out of this and how it is going to be for other companies who are having acquisition outside, like inorganic acquisition, and they are like having a bad time nowadays. So I would like to know more about how these companies will like come out of these, especially these micro cap companies. You have also posted about this last week while reading the con call. So I would like to know more about it.
Right. So, like just one thing I wanted to give as a disclosure that the threads which I'm posting on a Twitter, it doesn't mean like that I'm invested in all the stocks. So, lot of probably like 95% of the con call I just read to understand what is happening into a industry. Just to take this example forward of a HIL, that I am not invested into HIL because of some other reasons, but I just was going through the con calls and I have shared the notes on a Twitter. So it is a really challenging situation on a Europe, what is happening due to the energy cost. So definitely they are having the bad time, but there will be some other players which can get some opportunity due to these headwinds on energy cost. Like if you check the say con call of the stylum industry, so you'll understand that they are like having a decent presence on a plywood side on exports market, and then they can tap into this opportunity. So I'm not sure how the HIL going to tackle this situation, but like I keep checking what's happening into industry, so that I can like change and be aware that what things are happening right now in the market and what opportunities I have and how can I use them. So in case of I think HIL, the balance sheet is actually quite good. So I think like they will able to surpass it. We have to keep tracking it, and I personally also not invested yet into it. If it comes at decent valuations, then probably I might look. But I also have been tracking those companies who have gone out of India. So most of the cases, these companies face some challenges. That is has been like my view. So it has happened with Multech when they were like initially gone out and done their expansion, and now again came back to India. So you just check the history, like what it tells, and then you can accordingly, I think, take your call. On HL specific, I'm not sure how they will be coming back, but at least balance sheet looks okay. And after the acquisition, actually they have done very well in that German acquisition. But right now the energy cost in Germany has gone say 10 times. So definitely it will be difficult. It depends a lot on a war, and that is the external event. So no one knows that what will happen to it. So but what I try to mean is like you have to have an industry understanding to get the better opportunities, and to know if you have gone wrong anywhere, and then switch to the better opportunity.
Thank you.
So, Shashank, actively managed micro cap portfolio normally outperform the broader market over a long period of time, right? But equally, the drawdowns are equally big in case of micro caps. And more on a top of that, we often see the liquidity issue in such companies. So, how we should go about it? And if we there are occasions like when we obviously we'll be monitoring our investments, but again the period you talked about 2018 to 20, that was a very tough period. So when you say longer period, how much is the horizon, and like how much, I mean, if we ask for one investment, say if we short down one investment, so how long shall we monitor it before taking a decision whether it is working the way we thought or we are wrong on it?
Right, right. So I think like the investment horizon should be at least 4 to 5 years, because at least in this space of micro and small, because what happens is, uh, even if the company is doing well, market is most of the time doesn't believe or probably doesn't care about this company, and that's why sometimes the multiple remains low, even despite the company is doing well. And then we start cross questioning us that what I have invested, is it a right or is it a wrong. So market takes some time to understand that the company is actually a good company. And the re-rating which happens, it generally happens in a very short period of time. For example, out of 5 years, probably 3 to 4 years, the earnings might be on track. They are growing well, but the market is not interested into it. And uh, when the market understand that this is actually a good business, in next 1 to 1.5 year, it will give you the full re-rating. For example, a stock might be trading at say 7, 8, 10 p, and if they are growing say 20 to 30% CAGR for last 4 5 years, uh, the P re-rating from that say 10p to probably 25, 30, 40, market on top side, on upside and on bottom side can behave in a erratic fashion, and that is the opportunity for the informed investor. So if you are a micro cap or a small cap investor, I think the horizon should be at least 4 plus 5 plus years, so that you can completely assess the situation and give some time for your bets to work on.
Right, Shashank. So, Shashank, you just talked about re-rating. So, is there any, I mean, what all parameters do we need to look for because, before zeroing in on, and we can say that, yes, this can be a potential re-rating candidate? I mean, market perception and investor perception, I understand you just discussed. Is there anything else we need to look for?
I think re-rating again depends on multiple factors. There is no single factor, and I think growth is the single most important factor for the re-rating. If there is no growth into a company, market not going to re-rate it ever. And there are multiple case studies which you can do on that side, where there is no growth, even despite having the business is very good business, high entry barrier business, but if there is no growth in that sector, then market doesn't actually care. And market also is sometimes very foolish, that it doesn't care what type of a growth which is coming. So even if that growth is like going to sustain for a very short period of time, still market gives the re-rating for that particular period of time. And when the growth slow downs, then there will be again a good amount of correction which can happen. So we have to understand, like, because all the growth is not good. uh, the growth, one type of growth which will sustain and it will keep growing, another type of growth which there will be initially sudden burst into their earnings for a couple of years, and then there will be a flat earnings or maybe decline in earnings. So same happens with the P multiple. So 10 P multiple might go to 20, 30, 40, and that 40 also can come back to the normal. So we have to keep assessing what is the industry structure, and can it sustain, or it's just a pop, and then you probably better to exit out of that pop and uh, save your opportunity cost and the capital also. So as you was mentioning, like how the re-rating happens, so I think uh, like the growth is one criteria. Second is what type of, like, probably walking a talk is also kind of a good measure one should track, like whatever management is guiding, is they able to deliver it or no. Because market sometimes like what you might have tracked what has happened with the Lotus Lab. So I don't think personally it's a major issue. It These things keep happening, but the problem is that market is way ahead of current understanding or current situation, so it always extrapolate on upside and on a downside. So if you know that the company is really good, so it's actually opportunity for you to go and buy it, provided that it's available at decent valuation. And same thing as on upside also. So if the market understood it, and then it will again extrapolate that on upside, and that is also opportunity for you to get rid of it, because those prices generally doesn't come very soon. Uh, so 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 reasons for the re-rating can be management, whatever they have guiding, they're able to achieve it. It can be growth, it can be dividends. If the company is not giving the dividend, the market like don't give them the proper valuations, and as and when, because market is not sure that the company has real cash or no. So so there can be multiple, I think, the parameters for the re-rating. If the competitor is going out of a sector, if they are increasing their probably the market share into a sector, so there can be multiple things. But I think the most important is the growth, and if they able to do the sustained growth. Because sometimes what happens, if even if the company is growing at decent speed, the market like doesn't care about it until and unless market is very sure that this is the quality growth. Because this has happened, like say with the Avanti feeds. If you track the Avanti feeds, say in 2011-12, it was growing at very high speed, probably 30, 40, 50%, and the stock used to trade below 10p, or below 3, 4p, I mean 5, 6p. So so we have to give some time, certain time, and then like market sooner or later gives the re-rating if the business remains good. If the business is haywire, then it's a challenge.
Right, Shashank. So, Shashank, one question we have in the comments is from Kshitij Saxena, and I think selling a stock is everybody's, a question which everybody wants to ask. So, he's asking, how do you think about exiting small cap stocks? I have made money, but always lose in terms of booking profits. And I understand that we can't exit exactly on top, but still a rough idea would be of great help.
Yeah, sure. So yeah, definitely, like all the discussions what we have, or what generally people do in various forums and videos, is all about buying, and no one actually think much before selling, or the amount of time which they invest in buying, probably 1/10 of the time they invest in while selling. So selling is a very tough decision. uh, for me, like I decide the selling in two, three parameters. First thing is like, if my thesis goes wrong, what I was expecting, if that doesn't happen, uh, then I will go and get out of it, even if at the stock has fallen by 20, 30, 50%. So that doesn't matter to me. Second thing is, if there is a very high valuation, which has happened, like say in multiple cases. I will give certain examples also. So if the stock goes beyond, like say, 100p or so, so that is definitely, I mean, I am not that type of investor that the 100p will re-rate to 200p. So I might be wrong at particular point of time, but beyond that, I'm like, it's very difficult for me to hold. It's happened in the Tata Elxsi case. It has happened into some other like IEX case, and some other stocks where the market has extrapolated the earnings, and due to that euphoria, uh, like uh, they have taken the P beyond 90, 100, also. So that gives a very good exit. Um, you might be wrong for a span of time, say for next 1, 2, 3, 4 months. Like for example, in case of Tata Elxsi, I started selling it about from 6 7,000 rupees, and the stock has went to 10,000, and now it is coming back to like about, I think, 7,000 or something below 7,000. Same has happened with the IEX. So when I sold it about say 250 or something, this is like not 250, probably 750. I mean, it was pre-bonus, and the stock has gone to say 900 rupees at high. But like it is very difficult to sell at high, and then now from that level it is about like 50% corrected, 450 or something. Like I think 150 is the current price. You can multiply by 3, and then you'll get the current, like that price which I was talking. So selling is definitely difficult, but I think the important criteria one should have is, uh, am I audible, right?
Yeah,
I think.
Shashank.
Okay. Okay, yeah. So one criteria is, if industry dynamics has changed, and the whatever advantage they had initially, that has converted into some challenges or more competition, and they are losing the market share, or your thesis has gone wrong, then there is no doubt, like you just get out of it, and then look for something else. And then the valuation thing, that is the only two criterias which I generally prefer for the exit.
Right, Shashank. So before coming to Pluto, I have another question. Like Shashank, say we see that if capex is like there is certain percentage of the market cap, the capex amount is, and like we are looking for doubling earnings in coming 3 4 years. So, but again, these parameters we look for. But when we assess the company quarter to quarter, how exactly we can identify that we are going on the right path?
Like I didn't understand the question properly. So what do you mean by?
Basically, say the size of the capex which a company is doing, right? And we are seeing a visibility like the company will double its earning in say 3 years, right? So these are some
Right.
parameters which we look for so as to, I mean, generate good alpha in micro caps and small caps, right? But again, when we assess those companies, seeing the history, small history of the company, say the management is walking the talk and everything. But again, can we solely rely on the numbers or there are any other things we also need to keep in mind so as to, I mean, basically, so as to say that our theory is intact and we are on the right path as far as our investment is concerned.
Right. So, what I think is like, management is must. Like you need to have some historical understanding about the management, uh, to relate that capex with it. Like, for example, I'll give you an example of Deepak Nitrite. So Deepak Nitrite in 2000, I think 16 or in that range, they announced the big capex of 1500 crores of phenol expansion, and that time their balance sheet was stretched, and they have done like multiple QIPs and sold some land, and the investors were no, I don't think like they were expecting the results which Deepak Nitrite has posted after that. So that time definitely it was like a good amount of challenge, and that's why the stock was trading at those prices. So, but if you check the full history of the Deepak Nitrite, I've read the Deepak Nitrite con call from 2000 say 11 till 2000 like 22 23, and then there were like multiple, what you can say, the hints you will get what management has done in history, what they have say talked about in 2011. They have given certain guidance which I have added in my tweets, that they able to fulfill. So you have to get some feeling about the management and their execution track record, and that is how I think it is. That is how you can like go and take some position based on the historical, based on the future capex which they have planned. It is not a very straightforward thing, because if the company is, I mean, it depends on what product they are entering into, to be very specific. So if the company is like just continuing with the similar product, then I think it is less risky. But if company is completely getting into some other product, I'm talking specifically with say pharma, chemical, or these these sectors. So if they are going into new products and the company don't have much of experience, then also it can backfire, and it has happened with me also in some cases. So we have to check all the details. If the company have the management bandwidth, they have the technical capabilities, they have they have able to execute in history, and then that capex is uh, uh, like we can track. If it is a generally a similar type of capex, if the company is producing some product from last 20-30 years and just they are building the capex on top of that, so generally they don't fail because they have the expertise of that thing from the history. So on a product side also, which one can check.
All right, Shashank. So Pluto, you can unmute and ask your question.
Yeah, so my question is related to something that we already discussed in terms of you know see my problem is that entry and exit, because in most of these stocks liquidity would be less, so entry you have to basically build up, and exit, as you mentioned, that at times you have to sell at 50% also, because you cannot, it is not, these are not available on derivatives, so you cannot buy protection and all. So my question is to one is, uh, yes, if something fundamentally goes wrong, you have to exit at anything, as you said, even 50% cut. But is there a way, if you want to just ride the volatility but protect it, then how do you basically, uh, sort of hedge, or do you build a portfolio which acts, because of the diversification in the portfolio, it acts as a hedge, or is there a proxy which you use to basically, so any index that you buy uh, to use to basically hedge your portfolio? And second is, in the portfolio, can you talk about something about, if someone wants to build a portfolio of micro cap, what is the ideal size for a retail investor, number of stocks, sector concentration, and all? So that's my question. Thank you.
Yeah, thank you for your question. So I think you had mentioning about how to tackle the volatility. So for the answer for your first and second question is like similar, that you should have a moderately diversified portfolio. Don't go with the very concentrated of having a five, six, seven stocks. So because plus like they are the micro cap, so there can be like a lot of uncertainties which you might have because of either lack of information or like many things can happen or change into this micro cap space. So generally, I will prefer to have a portfolio of about 25 plus stocks, just to hedge against if something goes wrong, and then you keep tracking it. It's not like on a day one you'll be starting with the 25 stocks, because your understanding also won't be like complete, like what which businesses to buy. And plus another challenge is like all 25 stocks are not available at the right valuation. So you can have your watch list that you have completed your research on certain stocks, and then wait for them to come at the right valuation, and then up till that I think you can just give it a pass for the businesses which you don't like, and keep on building your circle of competence and your understanding, and then just wait for the right valuation. Sometimes you may not get them at like the valuation which you might be looking for. They may not come at your valuations, but I think it's a nature of game. You have to keep looking for newer and newer opportunities. Some goes in your favor, comes at decent valuations, and some doesn't. Um, but if you'll do it over a long period of time, I think you'll able to create a decent portfolio, and then you keep on maintaining that portfolio, keep on cutting your losers, and keep on building or like at least staying invested with which actually works. And it's very easy to say while talking into this space, but when you'll go and apply it on ground, it is very difficult, because the earnings doesn't come into a straight line. It will be a volatile earnings, like there might be some 20-30% cut into their earnings, and the stocks will also fall accordingly. and then that will be a real question that of your thesis, that am I like keep holding it, or as the earnings has decrease, I should get out of it. So then you have to go back and check like what is the reason for cut in earnings. Is it because of some competition has entered and permanently dented the business model, or is it because of some temporary headwinds because of external situation? May it be currency fluctuation, may it be shipping cost which has increased recently and coming back to normal, raw material volatility. So it's not only about the earnings goes down or volatility of earnings, and volatility of earnings is reflected into volatility of stock price. So real important question is why, what is the reason for that volatility of earning, and can it the can that company go back to the normal earnings, and then it might be opportunity for you to increase your position, or if it is actually due to some other reason due to which it is high possibility or probability that the earnings may not come to the normal and this is the new normal. So you can take your call and exit out of that situation or that stock.
Thank you.
Thanks, Pluto. There is one question. He's asking, I have a question regarding MDF industry. So he's saying he listened to con calls of Green Panel as well as Rushil Decker, and both have given contradictory guidance where Green Panel is cautious on growth. And his question is like, how can we assure that the management is right on the guidance since both are in the same industry and the guidance is just the opposite?
Yeah, it's a good question. So directly don't jump on the guidance of the managements just by reading a single con call. Check the history of the Rushil and check history of the Green Panel, and whatever management has guided historically, who able to fulfill their guidance. Rushil history is not that much. So I think only 4 5 con calls might be available. While for a Green Lamb, like huge history is there. I mean, I was just like reading their con calls from 2011 12 till current period. So multiple companies got demerged out of it. Initially it was Green Lamb, then it was Green Panel. So you'll get like lot of feel about the management, like how is the management, how what kind of guidance they have given, how they have able to execute, what kind of a brand they have, what kind of a management they have. So more and more history you'll have, the better and better understanding of the company you will get. So these things sometimes happens, like uh, the managements, like different managements into a similar sector can give little bit different guidances, but then go back and check what kind of a capacities which are coming, because it's a cyclical thing, it's not like a secular kind of a demand in MDF and like plywood and laminates industry. So if higher and higher supply keeps coming, then the realizations will get affected. And the good thing, I think, during this, means it has happened previously in 2018, but I think during this cycle, at least real estate is giving the good push, because the numbers which I'm tracking for the various large size and mid size real estate players, so they are getting a good demand for their spaces and like properties. We have to again check like how it can sustain with the current interest rates. But at least I personally am positive on Indian domestic market, on even on real estate also. So like it can be a good like at least 4 5 year cycle. Let's see, it's like today it feels like that, but tomorrow it might change based on the actual data. So so if real estate cycle continues, definitely the proxy industries of building materials will also continue with it. So you have to keep tracking and have to have multiple pointers which you can track. So single one pointer can be check how much supply and demand, not the demand, but supply is coming into a industry for the plywood side. Second thing is you can check what is the inventory level and supply which is coming into the real estate side. So at least these pointers you can check. And third thing is like go back and check the historical guidance of the management and how they able to fulfill and achieve it or not. The historical, I mean, like if the 10-year con calls are available, you should go and check all the con calls so that you will get a bit better understanding about the management and their aspiration, because certain managements are very aggressive, certain managements are very conservative. So it depends on like what type of management is, and that is how you will get a, I think, better clarity.
Shanky, anything further you want to ask, or you got your answer?
Yeah, thanks. I got my answer. Thanks.
Thank you. So, Shashank, just like when we have certain investments, right, we have bias, or maybe we always think like we have made the right decision, right? It's only in the hindsight we get to know that our decisions were right or not. But again, when we see these kind of biases, and when we have certain market perception, so how it would be, I mean, हमें कैसे पता लगेगा कि मार्केट परसेप्शन क्या चल रही है और हमारी थेसिस क्या है, मतलब so as to be a better investor, how we shall gauge that? I mean, got my question?
Yeah, I understood it. Uh, See, I mean, so the plain or very simple answer is like company has to perform. I mean, if the business doesn't perform, then sooner or later the market perception is going to be a right perception. Forget about like what perception you have. At least I'm talking in terms of like 3 4 years. If business is not going to perform, market is not going to give it any like good valuation. Same is the case if the business performs. So in short period of time, there are the cases that market doesn't value it properly, but in a long period of time, there will be definitely better and better discovery about that business, because it is keep on generating the cash and profits. So my simple plain theory is that look for the business which is going to give me the good profits and good cash in future. And if and currently also I am invested into one of that business, I won't take a name out of it. So market absolutely doesn't care about it, while the business keeps on posting better and better profits every year and every quarter, uh, and doing the capexes from their internal cash flows. There is absolutely no debt, creating a good brand presence in global markets, probably looking for certain acquisitions also because of their nature of the balance sheet, and it's trading at 10p, and and at very very dirt cheap valuation. So definitely it's a question for me also right now, that if I'm right, am I made a right investment, or am I made a wrong investment? But according to my experiences, like at least I will be giving it 3 to 5 years time. Um, if the business continues to grow its cash and profitability, which I think it is doing in a right way. There might be 1 or 2 quarters which might be down because lot has changed into the global market, and it has have certain global exports also in Europe and in US countries, and all. But good thing is like that they have the good balance sheet, able to collect well. They actually take the advances compared to uh, uh, sell on credit. So this gives me the confidence to stay invested, and there is a lot of margin of safety. So even if I probably goes wrong a little bit, so I think like I can exit with minimum cut. So this is like the live example which is going on, and it has happened multiple times in history also with me. But like in this case also, what I'm expecting is market probably won't care, say probably for next 2 years, even if the earnings are there, and then there will be a little bit discovery which will start happening, and whatever actual returns I'm going to get, it is not in next 2 years. It will be say say third year or fourth year, and in that particular short span of time, probably 3 or 6 or 1 year, I will get that 10 p to 20 30 p rating. I don't know what will be the upside p, but that is what always happens, and this will be the similar case. So my answer is that if a company is right, if your assessment, what you are expecting on a company, that say on a 3 year basis it will say double its profitability, and it is actually going in that direction, it instead of 3 it might take 4, but that is okay. Like no one can be very accurately correct about that, but it shouldn't happen like you are expecting 3 and company is going to double its profit in 5 6 years. So that will be challenge on probably the valuations which you have paid. But if the direction is right, then I think you should stay invested, and then keep on checking on a competition and market share also. So if the product is a niche product, and they are doing the right probably what you can say marketing and getting good response, increasing market share, and the market is not giving it a valuations, I think it is perfectly okay for a short period of time. And you check like what has happened from the 2015 or 2012 onwards to multiple chemical companies, be it the Aarti Industries, be it Atul, be it any company like alkyl amines also. You check, probably it was trading at like very cheap valuation before pandemic, like 2018-19. It was hardly no one is caring about that company, and then you see what kind of a re-rating that stock has got. And even though the business is very good business, but the current valuations I'm not comfortable. I also used to hold that stock, but I have exited because of the like super high re-rating. So I think like you have to stick to your investments if they are delivering according to your expectation. And the day you understand that like this is not going according to my expectation, then I think it is going into some other direction, then like it's better to get out of it, and then like shift to the better investments at that point of time.
Right, Shashank. So, Shashank, basically the businesses where growth is good and we can see the longevity of business, the normally the valuations which market give to those companies are at premium only. So, how we should approach those kind of businesses? And secondly, like when it comes to valuation, do you have any strict parameters like you cannot buy above this level, or maybe if the company say the investment has reached up to a certain level and you feel you are seeing that is not sustainable to say, so how you see this?
uh, yeah, so I think valuations and sustainability of those earnings, not valuation, is more of a function of a industry, and what kind of a supply demand it is there into a industry, and what kind of product is there, and according to that what kind of valuation market is giving. So definitely if you have a 25 stocks portfolio, you're not going to get all 25 stocks at dirt cheap. Out of what are stocks I'm holding, I'm probably getting like 2 3 stocks in that range, and rest I have to at least look for the moderate valuation. Everything at any point of time or at particular point of time, you're not going to get very extremely cheap. There might be certain pockets like COVID and like other major crashes in 2008 and 2018 onwards, that period, even 2015 also there has been good correction. But don't expect that a whole portfolio we can build uh, with the extremely cheap valued stocks. So I think very important is the growth which you are expecting, and like how long that growth can come, and then you keep assessing it on quarter basis, and then if actually that growth comes, then those valuations will I think sustain. But if that doesn't growth doesn't come, I mean market can give like the correction in probably 2 3 weeks also, and it gives a good correction in that particular stock. So it is very difficult to assess on live case studies what where to add and where not to add. So what I generally do, I mean, I don't add the full position on a day one. uh, I will start with certain position of say 1 2%, 3% of my portfolio, and then I keep on building it as the business starts performing it. And that actually gives the confidence, because price also knows certain time good things which are not disclosed in a public forum. And at the same time, in some other extreme cases, price like sometimes misbehaves. So you have to understand that, and I think that you'll get out of certain experience. um, Key, like where it is opportunity and where actually it can lead you, probably. Uh, so it's a dynamic situation, if you ask me, frankly. And create a portfolio which is balanced of different things. Just don't go for extremely undervalued stocks, because they might be undervalued for the reason. So, and it might happen that you don't know that reason. So there might be value traps, and you buy cheap and you have to sell it cheaper by booking a loss. And it can happen. It has happened with me also. So you go and build a portfolio, like where the valuations are decent, and the growth or whatever you're expecting, it there is a good probability of that it is happening. And to understand all these things, then you have to understand the industry structure, and how that industry has structured. What, like, you can apply the Porter five forces if you want to understand it in a better way. um, and like what are the entry barriers and all that thing. So it's a connected thing with multiple, what you can say, approaches or mental models, or multiple lenses. So a single business, what uh, which is looked from the one lens will look differently. From the another lens, it will look completely different. So you have to uh, keep giving it a multiple, what you can say, you have to view the business from multiple angles, and then only I think your understanding builds. And I think that will help you to take the decision what to, like, when to enter and when to exit, and when the things are not going into your direction, what to do, because it depends on case to case basis, I think.
Right, Shashank. So, Harshad, I'll come to you before I have a very important question. So, Shashank, it's like most of the people who are on social media, they are looking for some tips or maybe some names so that they can further investigate that company or maybe directly dive into that company. So, again, like the question is, people invest on borrowed conviction, which ideally should not be the case. But again, even if they are not that much expert so as to check all the nuances of the company, be it the financials and everything, management and all. But again, what are few checks which anybody can easily do in their capacity, so as if they are investing even on borrowed conviction, that can help them so as to save their money. I mean, so as not to get trapped, basically.
I think on a borrowed conviction, firstly, it is just go and check what valuations are you buying. If you are buying on a borrowed conviction at 50 PE, and when the stock falls, then that borrowed conviction not going to work for you. So I think it is better to have some sense on a valuation side. PE may not be a very right approach to the valuation, but it is also not very bad approach. So at least you will come to know if the things are expensive or things are cheap on a broader or on a basic level. So firstly, don't take any tips. You go and do your own research, and if you cannot do that, then probably look for someone who is actually, it's his full-time profession, and he is doing it for you. Probably some mutual fund or some PMS, or anyone who has the domain knowledge in that field, because micro and small cap investment is very difficult investment if if you don't know probably what you are invested into, because it's not like investing in HDFC Bank and Asian Paints and Pidilite, because they have proven themselves. They have good like track record and history with them. Their balance sheets are good, but that is not the case with the small and micro cap investing. Many things can change overnight, and then if you're not aware of those things, then like it will be the disaster for you. So it's better to go with the someone who actually knows it. But yeah, like a few checks might help you if you have the required time and all. So just firstly, I think check what business they are into, what valuations are you buying. Don't overpay for the businesses which are cyclical. And again, like one or two points I will tell about the cyclical. Whatever I know about it is cyclical investing is completely different from the secular investing. So if you think like Tata Steel is available or at 3 or 4p, or any metal stock is available at under 5p, 4p, it is cheap. It is not the case like that in cyclical investing, because when the industry will have the peak profitability, uh, the the business will have the probably lowest P multiple. And as and when the profitability will start declining, the P multiple will start looking higher and higher, and at some point of time there won't be any P because the company is making a loss. So actually that is the perfect time to go and buy that, like the leader into that sector, when the whole industry is into very bad shape, and the balance sheets are stressed and all. And then go and look for the probably the leader whose balance sheet is decent, and they can come out of uh, that situation. So P also is not like a right multiple always. It depends on which industry are you investing. So buying a Tata Steel at 4 multiple might be very expensive compared to buying a same stock probably at 50 multiple or 60 multiple, because the earnings has gone down. So that would be my like one or two parameters. But I will strictly like tell the investor, either you you go and research about it, um, and till you are fully convinced and understood, don't invest. You can keep learning is not bad. But if you go and invest your say 10-15% of the capital just because someone is telling you that this is going to work, then it is very difficult, because he not going to probably tell you when he going to exit. So you will remain with the company in a bad phase, and that person might exit. So your capital, you have to protect it well. So it's a journey. Like don't expect that from tomorrow onwards you're going to build a portfolio of 25 small and micro stocks by your own research or someone else recommendation. If you're doing it from number of years, then no problem, you can go ahead and do it. But if you are very new, then give yourself enough time and learn about this. It's a excellent what you can say field or profession. It's a lot more enjoyable. You'll learn many things, but don't expect that. No, don't expect the free lunches or get rich quick system. It is strictly not like that.
Yeah, very rightly said, Shashank. Basically, and even when we are starting, we should not be like saving some upfront fees for an advisor. We normally end up losing a big amount of money. So that shouldn't be the case. We should not be, I mean, what we say, averse to reaching out to the advisors. And if the frequency matches, definitely they can grow your wealth more than which you can do initially. So we have a very peculiar name, Harshad Mehta. Harshad Mehta, you can unmute and ask your question.
Yeah, hi everybody. Hi Shashank. My question is related to a company that you track very closely. It's a Saregama. Uh, as per what I believe and what I have researched and studied, I believe there is a long road ahead for the company with a huge moat. Just wanted to understand your view of vis-a-vis the latest earnings that they have posted and the kind of growth that you expect them to do. Thank you.
Sure. Yeah. Thank you for the question. I have created one detailed video about a year back on this, Prince. If you can share, or like I
Yes,
can check on my
yes, yes.
YouTube.
I've gone through the entire thing. I've been holding this
Yeah,
stock
yeah,
since 2008, although the premise of buying that time was quite
right,
different from what it is today.
right, right. Great,
Yeah, mainly wanted to understand vis-a-vis the last few quarters growth that they are reporting, and what
right.
do you foresee just ahead?
Yeah, yeah. I'm very bullish on the overall sector because it's a very different sector. Like it's a completely platform based sector,
Correct.
and it is not type of IT business. So which actually have certain modes. Like for example, if Saregama have some Lataji song, they not no one going to replicate that thing. It's a completely owned by the Saregama for next 50, 60, 80 years. So huge moat is there, and the repeatability of the music is very high. So that is another thing about like the music business.
Correct.
Plus, if you ask me like what is happening recently, so I think like the position of the Saregama which they have created in last say couple of years is very very good, and and they have the lot of cash which is available with them. I think some 750 crores of crores
Right.
they have done in QIP, and
Correct.
then they have like about some more cash also which is available, which is very good for the acquisition. I don't know when they will able to acquire the right candidate at the right valuations, which Mr. Mehraji was explaining in last call that like they are waiting for some valuations, good valuations.
Yes.
So business remains good. The longevity of growth is also very long. So which Prince I think has was talking. So I probably think like it is a very early start, at least in India, uh, where you can say the paid music is not much penetrated. It's
Yeah.
just a start. You
Yeah.
just go
Exactly. Yeah. Exactly. I wanted you to touch upon these 2 points as to what kind of contribution would the paid subscribers be vis-a-vis as they are today to maybe down the line, and is there any possibility of them using NFTs to probably sell a part of the catalog at a particular point in time in future when valuation just gets simply stretched, because we've seen even obscure pieces of music and art being sold at huge prices through NFTs. So is that also another possibility?
So your second question, any NFT, at least in India, I have not heard that any music company has able to monetize it at a scale. Saregama also in their con calls twice or thrice was just gave the indication, even if I'm tracking and was invested into tips industries also. So they also hinted that they are looking for it and they probably might monitor. So that is you can keep it as a optionality. If it happens, then well and good. If it doesn't happen, then still the original business not going to get disrupted or so. So that is kind of a optionality I think I will go with. And the first question on the this like penetration on music, premium music or the paid music. Actually, it started happening in a global front. There has been a good penetration. I'm not sure about exact number. I think it was some 500 million or what, but sooner or later it will happen in India. So already on a video side, it has started happening, and you see like almost most of we are using the paid plan of Netflix or some other plan on the Disney Hotstar and various apps. So it will also happen in music side. It might take a bit more time because we like historically never paid anything for the paid music. We just go on a go like YouTube and type a name of song and we listen it, or similar is the case with the various mobile based app. So it might take a time, but I think it will happen, and when it will happen, I think the industry will have a multiple, what you can say, multiple X, or like the growth will actually go into another domain because volumes will be there. Volumes are anyways growing at decent space on an industry level. I think it is growing at 13, 14, 15%. On a individual player, it might be more than 20, 25 also. But when that volume will get multiplied with the value, then the actual number will be quite a good number. So I'm also waiting for that to happen. Not sure like when it will exactly happen, but let's assume that it doesn't happen. So still that I don't think it's a bad industry. So so what probably Monish Pabrai says that heads I lose and I mean heads I win and tails I don't lose much. So this is kind of that kind of industry which I feel, because on a competition side also, there is not going to be a very huge competition on a certain like basically region wise it might be there. But if you check like Saregama is investing more on say south based music and Punjabi music, and recently they had tied up with Diljit Dosanjh. So multiple streams of the opportunity will start coming, I think, in next 4 5 years, and I feel it is a sustainable thing. It's not like a pop and it will come down until and unless we go back to the historical piracy, which is quite difficult from here on. So I think it's a much differentiated industry. uh, it is not like any IT type of industry, and definitely it has a very good modes with it, um, which any catalog have, if they have like, which any probably music label have, if they have the good amount of catalog, historical catalog. Along with that, if they're able to acquire like the newer songs at decent valuation, so that will keep adding on to their moat and their competitive advantage. And plus now in Saregama case, they have the very good balance sheet also. So I think like if you have a horizon of next 5 years, it can be a good compounder. May not be a multiplier because of the right current valuation, but might be a good compounder.
Thanks, Harshit, for your question. So, Shashank, it's like more than 15 minutes over 1 hour. So, how good we are on time? Shall we have 15 more minutes?
Yeah, you can ask, not issue.
Okay, great.
Like,
And guys, if you're liking our session, please do check our handles and do give a follow if you appreciate our work. So that would be motivation in the sense like we keep that gives us the necessary encouragement so as to bring more people and more content to you guys. So, Shashank, which two, three sectors you see? I mean, for a period of say 3 to 5 years, they ought to do good. And any sectors which you think are overvalued or maybe they have some headwinds down the line. So, yeah.
I personally definitely is bullish on chemicals and pharma and related side, but on specific to chemicals, I started feeling that the valuations has gone to another extreme. Be it like I'll specify companies also, say Tatva Chintan and Clean Sciences and many other stocks. So the problem is like these are not bad companies. They are very good companies, but market has whenever it's something market gets like a good and sustainable thing, market gives the full valuation. Plus another issue with these stock is like there is a very less float. About 80 85% float is with management and the relatives, and hardly anything is into the market. Uh, so like that I am not comfortable with the valuations. So you can look for something proxy to chemicals. That can be my first sector, like process equipments that you can look for. There are two companies, two or three, four companies which are listed. Top two are very highly overvalued. I mean, they had a fantastic run in their history from last 2 3 years. But there are certain pockets where the valuations is good, and the promoters are okay looking for the some capital raise and going to expand into their existing facility. So that is the another space which I'm looking, which is the proxy to pharma and proxy to chemicals, like it might be glass lining equipments, it might be process related equipments like nurse filters and dryers side, or it can be heat exchangers, it can be towers. So these like process equipment side, uh, that might be like one sector along with the chemical pharma I will look for. Plainly on a pharma, I will strictly uh, stick with either CDMO and CRO side if valuations are okay, or probably with some API companies which have a very high niche into a particular molecule. It might be a commodity also. I'm okay with commodity, but like we have to check then what is the cycle. It should not happen that you are buying a commodity API company at its peak of probably price, uh, and check the long term again, like visibility, or what is the historical development that company has done. It has to be a cheapest manufacturer if you are betting on a commodity API company. If it is not the cheapest manufacturer, then you'll get disrupted. And then on a like generic side, I am not looking anything. Branded generic is much better compared to US based generic, so that is another sector which I'm tracking. Third thing is real estate, which I'm tracking and invested also in certain very small companies, where again the uh, risk to reward is, I think, this like much in probably my favor right now, because again the same story is repeating. Market is not caring about this company, and probably they don't they probably don't able to value it properly because of the things which is happening into a global economy, that interest rates are hiked, uh, and also, so I think like I'm getting those assets at very extremely cheap valuations, compared to what kind of a land bank they have, and when they're going to monetize, monetize it. So I think like there is a good amount of margin of safety which is available. So I'm holding like couple of those investment into real estate side. uh, Next, I think building materials also can be a very good sector, but again the similar thing is like it is exploited a lot. The valuations in all, like on a broader level, not very comfortable. So you have to go for the some small not track companies where you will get a good valuation. So that is also can be a good long term uh, sector. Music is another which I discussed recently, and I'm also looking for like a couple of opportunities, or to be specific, a single opportunity to hospitality sector. So it's not again a very like a normal hospitality play. It is a bit different, and after pandemic, there has been a good recovery. Plus, I'm expecting good amount of volume will keep up coming for next 2 3 years. So that is also one of the opportunities. Again, a micro cap which I have invested. So just to sum it up, it will be chemical at right valuation, not any like exorbitantly high valuations. Process equipments might be second. Um Hospitals also can be a good opportunity if you can have anything at good valuation, because from there also I'm expecting like they got a tough time during the pandemic, and they're not able to focus on their core niche or core expertise, and as and when they are coming out of a pandemic, I think it will be a sustained growth which they might have. So that is the next one. Then in pharma, again I would suggest don't go with the large cap pharma which are generic. It is that market dynamic is bit difficult to get sustained profitability. So I instead of that, you can look for some API manufacturer or some CRAM, CDMO or CRO player. There are certain small CRO players also, not only the Syngene I'm talking, but there are like like 1,000 crores market cap, even 200-300 crores market cap companies are also there. If you understand and like can you can like just check about them also. So that can be another. Real estate can be next, and building materials. So these are the like 6-7 sectors which I am currently tracking. And my approach is generally bottom to top. I don't start with a sector. I generally start with a particular idea, and if I like that idea, which can have a growth potential in future, I will just I'll do my research, and if valuations are okay, I'll go and buy it.
Right, Shashank. So, Shashank, see, market is full of regrets, be it early selling or buying a wrong thing. But again, like when it comes to, there are missed opportunities, right? So, do you, or maybe any names, or if even if you don't want to name it, any missed opportunities you want to discuss?
You talked about missed opportunities, right? Your voice got lag.
Yeah, yeah, missed opportunity.
Yeah, yeah. So, see, market is, I think, all about regrets, which I think Rakesh Jhunjhunwala ji has spoken very well. So it's a regret when you miss opportunity. It's a regret when you sell a stock at 100 and it goes to 150. Uh, it's a regret if you book a loss at 50 rupees and it goes to 60 or 80. So it is always like that. But I think the size of opportunity in Indian market, at least in smaller companies, is huge and humongous. Like it is, if you miss like probably 4, 5, 10 opportunities, it doesn't matter at all, because there are 2,000 listed stocks. You can get opportunity from anywhere, provided that you are looking for it and you have your research behind it, and like time investment behind it. So I'm like, I don't have that fear of the like missed opportunity, because in India, like we have full of opportunities. Only thing is like you have to give a good amount of time behind it, because studying a single stock might take 1 or 2 or 3 or 6 months also. So it's a like over the period of time, you you keep getting better and better at what you can say, at filtering out the opportunities, so that you don't have to study everything. But and it is like how well you spend your time, day in and day out, for a long period of time. It is not like that like anything magic going to happen in next 15 or 20 days or next 2 3 months. It is like for example, I probably read at least 5 to 6 con calls every day. That is what my plan is. Sometimes it might be a bit lower end, but at least I try to do that. And i I'm doing it from like a good amount of time, and probably like going forward also. It's not about the current con calls, but I read the old con calls also, like 10 2010 2015 2018 con calls, whichever are available in public domain. So that gives a lot of understanding about how management thinks, how, like, because reading in between the line is also very important, which probably we start understanding as and when we spend a good amount of time in listening or reading con call. And I think listening a con call is much better than the reading, because reading is very plain, and then we won't get those emotions of the management, how they are talking and all. So listening is also a very good habit. uh, Probably like any one of you can just try listening a single con call. If you are going for a morning walk, it will be a very good time spent, I feel. Start with the one, and then you can keep building on that. So so that is how I plan, Prince. So no regrets on the missed opportunities. I know that I'm going to miss the opportunity. Question is that, like, whatever opportunity I'm betting on, how I can scale it up. So today only, I think I was discussing with one of the investor. So he was asking me, what is your hit rate, or what is your uh, how much percent you are accurate. So it doesn't matter how much times you are accurate. Even if you are accurate, like say 4 or 5 times out of 10, or maybe probably like even 3 times, but how how long you going to, what kind of alpha generation, or how much multiple times you can scale that opportunity, right? So for example, I can scale it to 3, 4, 5, 10x. So it doesn't matter like I'm wrong in remaining 5 opportunity or remaining 6 opportunities, and it is very difficult to be right on more than 5 to 6 opportunities out of 10 on a sustained basis. So mistakes will keep happening, uh, opportunities will be missed. But if I know something like this is like in particular opportunity I have invested, and it keeps on going in my favor every quarter or probably every year. Not quarter is not right measure, but let's say every year. And then I kept on building on it, and then after 3, 4 years, 5 years, I get a good like wealth creation out of it. So during that process, I'll miss 10 other opportunities. So that I think doesn't matter.
Right, Shashank. So we have a speaker by the same name. Shashank, you can unmute and ask. Yeah.
Yeah, yeah. Hi, good evening, everyone. So I'm also Shashank. Uh, so basically, I want to share my experience relates to the micro and the small cap investing, because I have spent almost 15 to 16 years in the market, directly to the BSc, and I have 10 to 12 years I have worked in the exchange. So I know how's the basically as per the my experience. I would like to share the my experience relates to micro and the small cap investing. So basically, what happened in reality, that there is a example like one company in every small and medium mid cap company, whenever it comes with the IPO, if immediately he'll get the boost of 4 to 5x, 6x, 10x return within a year, then it will be stopped for coming 5 to 7 years. Example like we have a company like Apex Frozen Food. If in 2017 it has been launched at 175 rupees, 200 rupees of the issue price, it has jumped to 5 times, 1000 till 1000 rupees, 5 times, 5x within 2 or 3 months. And after that, it has been diluted. I mean, it has been uh, discounted at the 300. So I'm trying to say that, okay, the journey of mid cap and the small cap stock is, it's in 10 to 12 years you will get the one opportunity. If you grab the opportunity on the time, that is good thing. Then you are lucky. But if you miss the opportunity, and you miss the opportunity and then you have entered into the similar script, then you have to wait till 4 year, 5 year, 6 year. In short, the longer time. So don't. I'm just suggesting you, or just sharing my view also, that okay,
Thank you, Shashank. We'll surely love to hear your views in our next spaces because we are almost on time and
yeah,
very
yeah,
sorry. We got
definitely.
your limited point and surely we will pass it on. So, Shashank, we are done with almost all the questions. But again, any concluding remarks and like, of course, the space is educational, but again, ethically, we can tell our audiences about your services. If you feel like you can share, otherwise, any concluding remarks from you.
I think like the details are available on site. You can go and check, and even if you don't wanted to like subscribe, it's your choice. Just check the YouTube channel. It is free for everyone. I have created probably like more than 100, 200 videos, and it really takes a lot of time. I have created probably 40, 50, 1 hour video, and to create a single video, we like it takes at least say probably 15 days. Then big process is there to like to edit it and everything. So, and it is everything free. Just you can like go and check what kind of a research we are doing at Value Educator. I hope that will be beneficial for you. And like I'm running a one small cap club. It's like a platform where the people can share their ideas, and collectively we can grow, because this field is like the information is not available much, the disclosures are not there, so that like to like the multiple people, if we can have from the different domains, then the collective understanding keeps building, and it is very difficult for a single person to go and like read about every company. Definitely I am sharing my own understanding about the different companies over there, so you can check it out about it. It is the details are available on website, and do check the YouTube channel. It is completely free, and I think it will be some value addition in your understanding. Thank you very much.
Thank you, Shashank. And guys, trust me, like no endorsement of any source, but again, I myself listen to his videos, and they are so much detailed. And even on some like pharma space CDMO, you will get 4 hours videos, so detailed, like no compromise on the content and quality. So again, that is freely accessible, so if you like, you can surely check that. And thank you so much, Shashank, for your time. And I think this is our second spaces, and I also shared the link of previous spaces over this, so those who were not available that time, they can also check in that and revisit that. So again, guys, let me once again reiterate, our spaces are educational, no commercials from either end. So basically, if any names are taken during the conversation, those are purely for illustrations or example purposes. So do not take it as a buy sell recommendation. Just understand the thought process and basically the framework which our guests follow, and take that as a starting point, so as to start your due diligence, because it is your money. If you lose it, we will not be responsible for that. The idea of doing such spaces is so as to bring different I mean, what we say, great minds in the industry, and they share their experience and expertise so that we all can benefit. And the most important thing is learning from their mistakes so as not to repeat them. So with this, I take your leave. Thank you again, Shashank, and surely down the line we'll again invite you for a special session like this. And it was really insightful and so thoughtful. Thank you so much.
Thank you for hosting, Prince. Thank you very much. Have a
Thank you. And thank you, Vajpayee, for patiently being a co-host. Thank you. And quickly, sir, one last question, Shashank. Do you also use technicals for your buy and sell?
I generally don't go with the technicals. I'm purely funda. Even though I have spent good amount of time initially when I was starting into investing on technicals, but then it creates a bias. If I really like something which is available at good price, then I go and like allocate the capital without checking the technical. But I mean, it's a individual approach, like how they wanted to do, but I don't mix my technicals and fundamentals. I do some swing based trading, but that is completely different. That is just to generate the capital, and over there my size of capital is also limited. I don't like go all in, and I don't take any leverage. Everything is from the cash. Um and the investment I keep separate. But while investing, then I don't look at any charts. I just look for the opportunity and the valuation and all other parameters, and not more of a charting kind of a thing.
Right. Thank you. Vajpayee, you were saying something?
नहीं तो प्रिंस जी, धन्यवाद भाई, आपने बहुत ही अच्छा एक सेशन किया। और हमारे जो शशांक जी ने काफी डिटेल में इतनी चीजें बताई, बहुत ही अच्छी तरीके से, और बहुत ही पेशेंटली लोगों ने सुना भी। तो देखिए, ये बस इसी बात के लिए मैं धन्यवाद देता हूँ कि आप इतना अच्छा अच्छा स्पेस करते रहते हैं, इतना समय भी देते हैं। इसका उपयोग लोग करते रहें तो बहुत ही अच्छा है, क्योंकि होता क्या है कि इतनी सब बात होने के बाद भी घूम फिर के बात यही आ जाती है कि आदमी केवल स्पेसिफिक स्टॉक के बारे में जानने का प्रयास करता है। और एक चीज मैं खाली कहना चाहूंगा, अभी जो इससे पूर्व शशांक जी ने एक बात कही थी, एपेक्स फ्रोजन का उन्होंने एग्जांपल दिया, तो नॉट ओनली एपेक्स फ्रोजन, इससे बहुत सारे एग्जांपल आपको मिलेंगे। तो ऑल टाइम हाई पर मैं केवल एक बात कहना चाहूंगा सभी लोगों को कि ऑल टाइम हाई पर अगर आप मिड कैप या स्मॉल कैप में एंट्री करने का प्रयास करते हैं या किसी वजह से, तो आप अपना एग्जिट का प्लान जरूर तैयार रखें कि हमें एग्जिट कहाँ पर और कैसे करना है। क्योंकि जैसे अभी एपेक्स प्रोजन की बात बताई, 1000 तक जाके फिर करेक्ट हुआ, तो जब मिड कैप या इसमें आपके माइक्रो कैप खासतौर से जब ये करेक्शन स्टार्ट करते हैं, तो उस समय बहुत बड़ी प्रॉब्लम होती है। और अब उनमें बहुत डीप करेक्शन हो जाता है। और कई बार मैंने ये देखा कि ऑल टाइम हाई पर ही बाई करने का एक इंथुसियाज्म लोगों के अंदर पैदा होता है। तो बस थोड़ा यही मैं कहना चाहूंगा कि ऑल टाइम हाई पर अगर आप एंट्री करते हैं तो थोड़ा उसका एग्जिट का प्लान जरूर तैयार रखें अपना साथ, सो दैट कि आपकी कैपिटल सेफ रहे और आप
Right.
उसको री इन्वेस्ट कर सकें दोबारा।
Right, right. Very wonderful input, sir. Thank you so much. And guys, there were some comments which were questions were stock specific. So sorry, we couldn't take stock specific questions as I initially told to everyone. So thank you for your time, everyone. And in case you have any feedback for our sessions and any guest suggestions, directly you can write to me or DM me so that I can request the person so as to share their insights over our forum. Thank you so much. Thank you. Good night, guys.
Thank you all. Good night.